Last Tuesday, the RBA held interest rates at 3.85% cash rate, and I sat down with CBA senior economist Belinda Allen to talk all about it. I'm Michael Carboni. My friends call me Carbs. Welcome to a very special edition of the Property Now podcast. Interesting news last Tuesday from the RBA. Everyone was expecting a rate cut, or 28 out of 32 expert economists were expecting a cut. But of course, the RBA held at the cash rate of 3.85%. Belinda, what happened?
Take a deep breath. Look, I think it's important to probably think about what the Governor of the Reserve Bank, Michelle Bullock, said. It's not about direction, it's about timing.
Yep.
So July for them was too soon. Yep. They wanted to wait and see some more data before continuing the easing cycle.
Yep.
So while we thought they would go in July, we'd seen enough in the data to think it was kind of needed and manageable for the Australian economy. The RBA just seems to have repivoted to be a little bit more cautious again and want to wait and see more inflation data.
So what sort of data are they looking for?
Primarily it's the inflation data.
Yep.
So I think we need to take a step back and remember, at the end of the day, the Reserve Bank has a dual mandate.
Yep.
They want inflation to hit the midpoint of their target band, which is 2 to 3%. So they want inflation to be around 2.5%.
Yep.
And they also want full employment.
Yep.
So you can tick on the employment side, right? You've got the unemployment rate steady at a bit above 4%. That's great.
Yep.
They're less convinced on inflation.
Yep.
And we've just come from a high inflation period, which has obviously impacted Australian households very dramatically. They don't want to have to fight inflation again. So they want one more look at inflation data, which we get out at the end of July. That's a full quarterly inflation release. We get partial readings on inflation. They just want to look at that, make sure what they're thinking on inflation's right and that they can continue to cut.
Yeah, great. So a little bit cautious, but at least they don't want things to go the wrong way after a decision. They want to make sure that when they cut again,
that's right,
it's for the right reasons.
That's right. And I think they just, as I said, they're an inflation-fighting central bank. We've just come from this period where we've had high inflation. It took so long to get that back under control.
Yeah.
And they are just cautious in relation to cutting interest rates. And I think it also stems from the fact that interest rates, they did go up a lot, right? They were 0.1%, went up to 4.35%. We didn't do as much as other countries around the world.
Yep.
It's going to be a pretty shallow rate cutting cycle. We don't have a big fall in interest rates expected in Australia. So they're being quite cautious as to when they cut rates.
Yeah.
And I think that's what stumped not only economists but financial markets. It was pretty much fully priced by financial markets.
Yeah, people were expecting it. It's priced into the market.
They were.
Home buyers were getting ready again, almost, if you listen to all the real estate agents out there. But it's very interesting, and what I found interesting too was they actually published the voting. So I think they said,
did.
So like three were against.
Yes.
Staying, and 6 voted for staying.
That's correct. So this is the first time the Reserve Bank has published the votes.
Yeah.
So just to take another step back, the Reserve Bank has undergone a review by the federal government or Treasury in recent years just to try to get it operating a bit better, maybe more in line with what we're seeing offshore. And one of those recommendations was they should publish the votes when the decision was not a consensus.
Okay.
So this was the first time we'd seen that. They're unattributable, so we don't know what board member voted for a cut or a hold.
Yep.
But it was a split decision, which I think also shows you that people and RBA board members are viewing the data a little bit differently at the moment. So no wonder we got it wrong, where the decision was split as well.
And that's interesting. So it's normally unanimous. Is that what you...
Well, it's always been unanimous, but this is the first time they've actually published the split. So we'll get that going forward now if it's not a consensus decision.
Yep. And you spoke to sort of the sentiment, like everyone was expecting this to happen. Now that it's paused again, do you think we pull the handbrake up for another 6 weeks or so? Or what do you think, how do you think the market or the people will respond to this?
So I think generally financial markets are probably feeling a bit nervous about what to expect from the Reserve Bank going forward.
Yep.
So like what's their reaction function to the data?
Yep.
So we generally think they'll cut rates in August.
Yep.
Barring inflation is way too high.
Yep.
Like if we get a data print that inflation shows it's re-accelerating, then they may well pause. That's not our base case.
Yep.
So we think they'll take the next 5 weeks to look at the incoming data flow, see what's happening globally, because there's still a lot happening globally in terms of Trump, trade and tariffs, and reassess the situation in August.
The 3 Ts.
Yeah, the 3 Ts. But we generally think they'll cut in August, they'll cut again in November, and then still a risk that they have to do maybe one more early next year if we don't get the recovery in the Australian economy that we're expecting.
So the position is still 2 to 3 more cuts, which was the position before Tuesday.
Just a
We've
timing
just delayed
shifted.
it. It's
We've
just timing shifted now.
Like we thought maybe, given what we've seen in the economy, we know the consumer spending recovery is quite fragile.
Yep.
That the Reserve Bank may want to cut the cash rate quicker.
Yep.
Clearly, they're taking a much more cautious approach.
Yep.
So more rate cuts coming. It just looks like it's now slower than what we thought a few weeks ago.
Yeah, okay. And so could this possibly happen again? Could we pause again in 6 weeks? It all just depends, right?
It all depends on the data flow. So the inflation data is paramount at the moment.
Yep.
They'll be looking at the quarterly reads on inflation. If it's continuing to show inflation's coming down, remember we want inflation around 2.5%.
Yep.
They'll be looking at that. As long as that continues to show that's on course,
Yep.
then the rates can continue to come down. But it'll still be a shallow cutting cycle.
Where's inflation at the moment?
So at the moment, the Reserve Bank like to look at this thing called trimmed mean inflation.
Yeah.
I know that's a very technical term.
Yep.
All it's doing is it's taking off the volatile price moves. So it trims out the top 15%, bottom 15% of price moves.
Yep.
Just gives a better underlying pulse. It's sitting at 2.9%.
So 2.9.
at the moment.
So they want to get it close to that 2.5.
And their forecasts are showing we will get there.
But what's going to bring it down to that point?
So we're seeing moderation in a number of areas. So
Yep.
new dwelling construction costs, important for your
Very
sector.
important for us, yeah.
They were rising by well over 20% per year a couple of years ago. They're now looking like they're barely growing.
Yep.
So that's helped pull inflation down. Rents are also starting to moderate. We're seeing less inflation in what we call market services. So it's like getting your hair cut,
Yes.
going out for dinner,
Yep.
taking your dog to the vet. Prices are starting to moderate there
Yep.
as well. So that's all helping inflation come down. And obviously one of the biggest drivers of that has been a weak consumer recovery. Businesses can't pass on higher costs
Yep.
because the demand's not there.
Yep. And I've seen, we've had a record number of businesses close down this year, which is scary to see. And I guess people are hesitant. I guess people have been hesitant to go out, to consume, to have fun. Oh, and I guess, look, it's a broad statement. It probably depends on age demographics as well.
Home ownership status,
exactly.
income quintile. We talk about a fragile consumer recovery, but within that, there are so many moving parts. Like we can look at the CBA data and those over the age of 60, spending's been quite good.
Yes.
Spending for 20 to 30-year-olds, not so good.
Yep.
Those who own their home outright, spending's outperformed.
Yep.
We're starting to see some shifts come through with the recent interest rate cuts, but it's still a fragile recovery. But there's no one story for the consumer, as I like to say.
But it makes a lot of sense, right? If you've paid off your
course.
home, or if you're probably a little bit older, more established, you can go out to dinner, you can go on holidays, you can do more of what you like. But if you're at the start of, say, a home loan, a mortgage, it's tuna cans and baked beans for a little while, and that's probably always been the case.
But it's been heightened given that lift in interest rates that we saw over the last couple of years, together with high inflation, a high tax take as well. So when we talk about all the pressures on the household budget, we think interest rates, it's been more than that.
Yeah.
And putting that together, we've seen a big preference for households to save, pay down debt. So that looks like it's continuing. And the real risk is a more delayed rate cutting cycle makes that consumer recovery maybe take a little bit longer.
Well, exactly. If everyone was expecting a cut and now it's maybe 6 weeks away, date night has to be delayed for a little while.
Yeah.
I have to tell my wife.
It's another headwind. Yeah.
Some of the data that your team produced after the May cut was really interesting because you're talking about people trying to save and maybe trying to get a little bit ahead. Something like 1 in 10 of mortgage holders chose to keep their rate as it was before the cut rather than accept the extra few dollars every week. Can you tell us a little bit about that data and what was interesting about that?
So data produced within CBA after the February rate cut and also the May rate cut for both of them shows that after February, 14% of eligible customers lowered their mortgage repayment.
Yep.
The data for May shows 10% have changed their mortgage repayment. Obviously, we're still looking at that data given it's a bit delayed, but it's still a pretty low share that have chosen to lower their repayment. I think what we're seeing definitely is still a really strong inflow of people paying off their mortgage quicker or putting it in their offset account, which says a lot about the household psyche at the moment.
Yep. So what does that, let's unpack that a little bit. What does that actually mean, or what do you guys think that means? Why are people doing that?
I think it's just we've seen a bit of scarring in recent years.
Yep.
So we saw a loss of real household disposable income. So I guess think about money left over after inflation, after higher taxes, after mortgage repayment. What is left over fell.
Yep.
During 2022, 2023 into 2024. So households just now appear to be more cautious.
Yep.
Even though income's now rising, inflation's moderated, interest rates are coming down, it just seems everyone's still recovering. Bit of a hangover from that period, if you like. So they're taking very cautious decisions with their money and maybe used to saving a bit more. They want to get their home loan down a little bit faster. Yeah. So I think that's all playing into it.
Yeah, I think it makes sense. When interest rates were at all-time lows, people were okay with a little bit of debt. You weren't too worried about that.
Yeah. Whereas now you're incentivised to pay off your debt because interest rates are on the higher side.
Yeah. With that data, are we seeing it more in certain cities or states, or is it pretty much across the board?
So it's a little bit more in New South Wales. So probably the best way to think about it is if you look across Australia, household indebtedness is much higher in New South Wales and Victoria.
Okay. What do you call that, sorry?
Household indebtedness.
Household indebtedness.
Yes.
I like
so
that.
the level of debt. I
like household indebtedness. That's a great phrase.
Is higher in New South Wales and Victoria just because home prices are higher.
Yep.
Like the median home price.
Yep.
Higher in New South Wales and Victoria. So you would expect those states to be a little bit more sensitive to interest rate changes, and that's what we've seen.
Yep. Yeah, beautiful.
There have also been the laggards with spending as well. So if you kind of look at around Australia, where spending has recovered the slowest, it's generally been Sydney and Melbourne.
Yes. Yeah. And it makes sense as well.
Of course.
Yeah, perfect. That's fantastic. I appreciate all the info today. If we can give one clear takeaway for the Copositors at home who are thinking about, getting into the property market, getting their next foot in the next step in the property market, what should they be doing, or what can they expect in the future, in your opinion?
So I'll go two things.
Yep.
Interest rates should still come down.
Yep.
So we saw a pause. Interest rates aren't going to go back up in the near term. So interest rates should still come down. It's going to be a shallow rate cutting cycle. Home prices are responding to lower interest rates. So we've already seen home prices lift in recent months. Generally, they are sensitive to lower interest rates, so we are expecting home prices to keep lifting this year and next because of the interest rate story, and we're still seeing constrained supply across Australia.
It's really interesting because if people are looking, maybe this is a little bit of breathing room for them before things start to really change.
We'll see. We often see that in winter as well, right?
Yes. Yeah, winter's coming. It's here. Belinda, lovely to chat to you. Thanks. We'll try and get you on again sometime. Maybe next time there'll be a rate cut and we can chat again about that.
Thanks very much.
Cheers.
This is Jason He, the sexiest voice in property, here to tell you that the Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only, and general in nature. It does not take into account your objectives, financial situation, or needs. It does not constitute professional advice. Always seek expert guidance before making any property-related decisions.